52.63 million ounces, against 81.73 million. Let that ratio land. That is not a prediction. That is not a theory from some anonymous blog in a corner of the internet. That is the live, published official CME Group warehouse data as of March 9, 2026, and what it reveals about the silver market right now should be the only thing on your radar today. Because in the March 2026 COMEX delivery cycle, delivery demand for physical silver has surged to 52.63 million ounces on first notice day alone. And the total registered silver inventory, meaning the metal that is actually available, legally designated, ready to be handed over, stands at just 81,733 ounces. Do that math. That is 64% of every single deliverable ounce in those vaults spoken for in one contract month. 1 month. And those numbers are not from last quarter. They are from yesterday. Welcome back. OG John AG here. And before I go any further into the data today, I need to address something directly, because if you are watching this and you are confused about where you are, I owe you clarity. My main channel, the original OG John AG channel, the one many of you have been following for months, the one where all of this analysis started, has been completely removed from YouTube. Gone. No warning that mattered. No appeal that worked. The entire library, the entire subscriber base, every video I ever published on that channel, erased. And what happened next made it worse. Within days of that removal, fake channels started appearing. Channels using my name, channels using my face, channels calling themselves OG John AG, with slight variations, backup numbers, extra words tacked on. None of them are me. Let me be absolutely clear about this. The channel you are watching right now, OG John AG 2.0, is the only legitimate backup channel of the original OG John AG. This is the only place where I am publishing. This is the only place where the analysis you have come to trust is being produced by the person who actually built it. Every other channel using my name or my brand is an imitation, and I have no control over what they post, what they promote, or what they sell. Do not trust them. Now here's the part I need you to really hear. There is a very real possibility that this channel, the one you are on right now, that could also be removed. I do not know when. I do not know the exact mechanism. But based on what happened to the original channel, I am operating under the assumption that OG John AG 2.0 is living on borrowed time. So I am asking you to do something very specific. Stay ready. If this channel disappears tomorrow or next week or in the middle of a delivery cycle that the world needs to understand, I will find a way to come back. It may be a brand new channel. It may be a different platform entirely. But I will not stop producing this work. The information is too important and the moment is too critical. So pay attention to the community tab. Pay attention to the descriptions of these videos. Pay attention to any pinned comments. Because if I have to move again, the signal will come through those places first and the window may be small. I am telling you this now, while I still can, so that when it happens, if it happens, you are not caught off guard. You already know what this channel delivers. You already know there is nothing else like it in this space. So stay locked in, stay alert, and let us make every single video on this channel count while we still have the platform to do it. And if you have been following this channel, you already know that this market is not behaving normally. But what I am about to show you in this video is something else entirely. This is not volatility. This is not a pullback and a recovery. What is unfolding right now in the silver market is a structural collision between two realities. The paper price that trades on a screen and the physical metal that is disappearing from vaults faster than the system was ever designed to handle. And those two realities cannot coexist much longer. If you want to understand what is actually happening in precious metals before the mainstream financial press decides it is safe enough to cover, you are exactly where you need to be. Hit that subscribe button, not because I am asking, but because in the next few months, the information in this channel will matter more than almost anything else you are watching. Now let us get into it. March 10th, 2026. Silver is trading at $89.20 per ounce on the spot market, up 2.51% from the session before. Some feeds are showing $89.81, up 5.28 on the day, a 6.25% single session move. The number is moving while you are watching this. Gold, meanwhile, is trading at $557.81 per ounce, up 0.36% from the prior session. The gold to silver ratio currently sits at approximately 57.8 to 1. 12 months ago, that ratio was above 100 to 1. In April of 2025, it briefly touched 105 to 1. Silver has compressed the ratio by nearly half in less than a year, gaining ground on gold at a pace the market has not seen in over a decade. And yet the number that will define whether this entire price discovery mechanism survives is not the spot price. It is that COMEX registered inventory figure, and it is still falling. To understand why 81.73 million ounces is the most dangerous figure in the precious metals complex right now, you need to understand what happened between January 29 and the moment you are watching this video. The story of silver in 2026 is not a simple bull market. It is a detonation followed by a scramble. And right now, we are somewhere in the middle of that scramble, and nobody in the mainstream media is connecting the dots. January 29, 2026, silver touched 121.67 per ounce, an all-time nominal high, a number that would have seemed laughable to most analysts 14 months earlier, when the metal was trading below $30. The rally that produced that price was extraordinary. Silver had surged 68.5% in the single month of January alone, 68.5% in 31 days. And then, within under 30 hours of touching that high, something the Silver Institute later described as an unprecedented event occurred. The price collapsed. London silver fell to 71.67 per ounce. That is a 41.1% drop from peak to trough in less than a trading session, 41.1% in hours. Now hold that image for a moment, because the question that most people are still asking, the question that the financial media fumbled, is not, why did silver crash? The real question is, after a 41% crash, why is silver already back above $89 and climbing? Why did the floor hold? And why does the COMEX data today look more stressed than it did before the crash? That answer is where this video lives. The Silver Institute published its 2026 outlook on February 10th. The silver market is expected to remain in deficit for a sixth consecutive year, with a projected shortfall of 67 million ounces. Sixth consecutive year. 67 million ounces of structural supply gap between everything the world digs out of the ground, recycles and reprocesses, and everything the world consumes. When a market runs a deficit of 67 million ounces, it has to draw that silver from somewhere, from above-ground inventories, from ETFs, from exchange vaults. That process has been happening quietly for 5 years, but in 2026, that quiet process collided with the loudest year the silver market has ever seen. Here is where the data gets surgical. Total global silver supply in 2026 is forecast to reach 1.05 billion ounces, a decade high, up 1.5% from the prior year. Mine production alone is projected at 820 million ounces, up 1% year on year. Mexico remains the world's top producer at approximately 185 million ounces annually. The supply side is not collapsing, and yet the deficit persists, because the demand side has fundamentally shifted in character. Physical investment is forecast to rise by 20% to 227 million ounces, marking a 3-year high. After 3 consecutive years of declining investment demand, Western buyers have come back. Hard, coin and bar demand has strengthened in multiple markets simultaneously. But here is the driver that changes the entire trajectory of this metal over the next decade, and it is not the one most retail investors talk about. Data centers, artificial intelligence, AI infrastructure. The next generation of server builds, liquid cooling systems, and high-conductivity electrical components require silver in quantities that were simply not being modeled into demand forecasts as recently as 2023. AI build-out is now a structural long-term demand driver for silver. The Silver Institute confirms that expansion of data centers and AI-related technologies is expected to support silver consumption, even as photovoltaic demand undergoes its own transformation. Let us talk about solar, because the narrative here is more complex than most people realize. Silver-paste costs per 450-watt solar module have increased from roughly $522 in early 2025 to approximately $1765 by early 2026, a 238% cost increase. The solar industry is actively accelerating its shift away from silver, pursuing thrifting and outright substitution. Photovoltaic demand is expected to fall in 2026 even as global installations continue rising. So here is the tension. Solar is pulling back, and yet the deficit is still 67 million ounces. The demand from AI infrastructure, EVs, semiconductors, and physical investment is not just replacing lost solar demand. It is running well beyond it. Pull that thread. Now comes the question I want you to hold in your mind for the next few minutes. If supply is at a decade high, if mine production is growing, if solar demand is actually falling, why is the COMEX running out of deliverable silver? The answer is not where most people are looking, and it changes everything about how you read this market. The answer is China. On January 1, 2026, the Chinese government implemented strict export controls on refined silver. One date, one policy decision, and the effect on Western exchange vaults has been profound. Before those controls, when prices diverged between New York and Shanghai, physical metal would move through arbitrage flows. Silver would flow east when the premium justified it, and the system would rebalance. That mechanism is now broken. As of today, the Shanghai Gold Exchange is showing a persistent premium of $8 to $13 per ounce over New York COMEX prices. That gap is not being closed by arbitrage. It cannot be, because the metal that used to flow in that arbitrage is now locked inside Chinese borders. What this means in practice is that the physical silver market has bifurcated into two distinct pricing zones, one in the east and one in the west, and they are no longer connected by the physical flows that used to keep them aligned. The COMEX is not just dealing with domestic demand, it is now absorbing the consequence of losing an entire continental supply corridor. Let us return to the number that opened this video, 52.63 million ounces of delivery demand, 81.73 million ounces of registered inventory. Reports indicate the CME group had already seen 74.38 million ounces move through delivery processes in the March cycle. The buffer is measured in days, not months. And here is the data point that recontextualizes everything. In mid-February, the CME group raised margin requirements from 15% to 18%. That single action triggered the leverage unwind that sent silver from $121 through $71. A 41% collapse engineered through financial mechanics, not through any change in the physical supply picture. The vaults did not fill up, the deficit did not vanish. The margin requirement changed, the leverage longs were liquidated, and the paper price was destroyed. But the physical demand kept coming. A single-day report from COMEX warehouses on February 11th showed a negative adjustment of 356,1082 ounces in the registered category, nearly 3.3 million ounces removed from deliverable status in one trading day. That is institutional actors pulling metal as fast as the system allows. Layer this on top of China's export controls, the bifurcated pricing, the 31% decline in registered stocks from prior year levels, and the sixth consecutive deficit. The crash from $121 to $71 looks less like a market correction and more like a managed demolition designed to shake out weak hands before the physical crunch becomes undeniable. Here is a cliffhanger I want you to sit with. If the COMEX is this stressed at $89 silver, what happens to the pricing mechanism if registered stocks fall below 60 million ounces? Below 50 million? At what point does the institution built to price this metal lose the ability to credibly guarantee delivery? Hold that question, because the bullion banks with the deepest short exposure in silver, HSBC, UBS, Barclays, Citigroup, are also the primary dealers in gold. If a silver delivery failure triggers a loss of confidence event, those institutions face forced liquidations across their entire book. The cross-contamination risk between silver and gold is not theoretical, it is structural. The gold all-time high of $5,608.35 was set in January. Gold is trading at $5,057 today, still within 8% of its all-time high. The DXY is at 98.656, down 5.05% year over year. A weakening dollar with gold near all-time highs and silver, 171.53% higher than 1 year ago, while the COMEX runs on its thinnest registered inventory buffer in exchange history. These data points are all part of the same story. And most people watching financial media right now have never had these facts arranged in front of them in this order. Now let us give the other side of this trade the respect it deserves, because this channel does not operate on conviction alone, it operates on data, and the bearish case for silver right now is real, specific, and needs to be understood. Marko Kolanovic, former chief global strategist at JP Morgan, one of the most widely followed macro analysts in the world, has been explicit. He sees silver trading back toward $50 per ounce later in 2026. His argument is not based on supply-demand fundamentals. It is based on market structure. Silver hit $113.25 earlier in the cycle, a 264% gain from 1 year prior and a 54% surge in a single calendar month. Kolanovic's view is that moves of this character are not purely driven by structural deficit dynamics. They attract speculative capital, what he described as meme traders attempting to take over the market. And speculative capital is not permanent capital. It rotates, it panics, it liquidates. The CME's margin hike from 15% to 18% was precisely the kind of pressure that triggers that rotation, and it worked for 40 days. Silver came from $121 to the low 70s faster than most retail investors could process what was happening. The question Kolanovic raises is, Could it happen again? The margin changes have not been reversed, and the leverage in the system, while reduced from its January peak, has not been fully unwound. MKS PAMP strategist Nikki Shields described current silver price action as showing unheard-of volatility, pointing to wild liquidity flows rather than supply-demand as the primary price driver. Galena Asset Management's Maximilian Tome echoed this, noting that fundamentals alone cannot explain a commodity running 200% in a year. These are not bears screaming from the fringe. These are serious analysts within the institutional metals community, raising a legitimate structural question about whether the current price reflects reality or a leveraged fiction still in the process of unwinding. That is a real risk. Acknowledge it. But here's what the bears have not fully accounted for. Scrap volumes are projected to rise 7% in 2026, surpassing 200 million ounces. Jewelry demand is down over 9%. Silverware demand is contracting 17%. These are demand destruction signals, the market's corrective mechanism. The bearish case has data in these segments. But the demand from AI infrastructure, industrial applications, and physical investment is not price-sensitive the same way jewelry is. A hyperscaler building a 500-megawatt AI campus does not reduce their silver specification because the price moved from $30 to $89. They buy what the design requires. Now I want to show you something about the iShares Silver Trust, SLV, that very few retail investors are currently discussing. As of March 9, 2026, the SLV NAV stood at $75.58 per share. The fund's 52-week range runs from $27.46 at the low to $107.35 at the high. 1-year total return, 171.27%. Those are extraordinary numbers for an ETF that most people still think of as a conservative metals allocation. But here's what the COMEX stress data adds to the SLV picture. SLV, as the world's largest silver ETF, has faced renewed scrutiny over its sourcing of physical metal during periods of extreme delivery demand. The Sprott Physical Silver Trust has been trading at a premium to its net asset value precisely because investors are seeking guaranteed physical backing in an environment where the guarantee chain from paper to physical metal is under visible strain. That premium is not irrational. It is a real-time market signal that physical metal commands a valuation that paper-backed instruments cannot fully replicate. In the context of global ETP holdings currently sitting at approximately 1.31 billion ounces, consider what a 5% redemption wave looks like. 65.5 million ounces looking for physical delivery simultaneously, against COMEX registered stocks of 81.73 million ounces. There is not a scenario where that math resolves quietly. And that is not a prediction. That is just arithmetic. The Wheaton Precious Metals streaming deal, $4.3 billion with BHP covering the Antamina mine, tells you how institutional capital reads this environment. Pan American Silver has guided 25 to 27 million attributable ounces for 2026. You do not sign a $4.3 billion streaming deal if you believe silver is going back to $50 in 6 months. Institutional behavior is communicating something that analyst price targets are not. And here's the final variable the market is currently mispricing. The DXY at 98.656, down 5.05% in the past year. The dollar has weakened against the euro, yen, pound, Canadian dollar, and Swiss franc simultaneously. The administration's Section 122 tariffs have not strengthened the dollar as classical trade war theory would predict. They have weakened it because the market reads tariff escalation in 2026 as capital flight from U.S.-denominated risk. January core producer prices jumped 0.8%, the steepest since mid-2025. The first fully priced rate cut has been pushed to July at the earliest. In that environment, sticky inflation, a weakened dollar, geopolitical tension, stalled U.S.-Iran nuclear talks, gold at $5,157, and silver at $89 are the logical output of the macro environment. The dollar losing 5.05% of its value while you hold physical silver that is up 171.53% is not a coincidence. It is the direct mechanism. Pull up the COMEX silver inventory reports tonight. Look at the registered column. Not eligible, not total. Registered. That is the only number that matters for delivery capability. Watch it over the next 2 weeks. The March delivery cycle is not over. Every ounce that leaves the registered column is one fewer ounce, standing between the current pricing structure and a reckoning the exchange has been managing through financial engineering for 6 weeks. The engineering is impressive, but it has a limit. And that limit is physical. Here is the question that will define the next chapter of this market. If the COMEX has been using margin hikes, cash settlement incentives, and aggressive contract management to prevent a formal delivery failure, and registered inventory has still fallen 31% despite all of those tools. What happens when the next front month arrives and the institutions that took the margin-induced loss in January decide they want the metal, not the cash? That is not a rhetorical question. That is the operational question the CME Group's metals division is answering right now. In real time, behind walls, most retail investors cannot see through. Most of the people watching financial content today are looking at a silver price chart and trying to figure out if $89 is a buy or a short. They are reading price. What you have just done is read structure, and those are two completely different activities. The people who understood COMEX registered inventory mechanics in January 2021 during the first silver squeeze saw what was coming before the price moved. The people who understood the China export control decision on December 31st, 2025, understood January's $121 before it happened. Right now, the structure of this market is communicating something specific. The registered vaults are at multi-year lows. The deficit is 67 million ounces for the sixth straight year. The dollar is 5% weaker than it was a year ago. The margin engineering that crushed the price in February is showing diminishing returns. And today, March 10, 2026, silver is already at 89 or 20 and climbing again. Not because of meme traders, not because of social media, because the metal is not where it is supposed to be. If this video connected information for you that you have not seen connected anywhere else, and I genuinely believe it has, then you already know what to do. Not because I am telling you to click something, but because you know that the channel that gave you this level of analysis today will have the same level of analysis when the registered inventory number breaks below 60 million ounces, and the conversation finally reaches the mainstream. The information does not stop here. The story does not stop here, and neither should you. There is a very small group of people who now understand silver not as a commodity chart, but as a structural event in slow motion. You are one of them. If you watch this entire video, and the data I just showed you is going to change how you think about the next 90 days, leave exactly this in the comments, OG John AG 2.0, because I want to know how many of you went all the way through the data with me tonight. Not everyone will, but the ones who do are the ones this channel exists for. Invest with logic. Strip away the noise. Follow the structure. That is the only edge that survives every cycle. The vaults are emptying. The clock is running.